Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Capital One Financial Corporation, ticker COF. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, we see this is in the consumer finance industry, has a market cap of $49 billion, EV of $67 billion, so it is quite leveraged. This operates financial services holding company for Capital One Bank, so it is a bank, and they primarily operate with credit card, consumer banking, and commercial banking. They have checking accounts, money market deposits, and they also have this company has a very big credit card business from what I know of them. So when we look at that, keep that in mind. Now, return on equity is really interesting. They had a loss in 2008, like many banks, but otherwise it's been quite cyclical. You have numbers that began in the early 2000s in that 20% range, and you quickly fell down towards a loss in 2008. Now, in a more normal operating time period, it looks like from 2010 to 2016, they had about 10%, 7% in 2016, 4% return on equity there, 11% 2018, 2019, 10%, 2020, 4%, 2021, 20%. So there is some cyclicality here, but there's also many years that are very, very stable. So it's hard to know what these cyclical years are. 2020 was, of course, COVID, but 2021 was the recovery. So it's really interesting to see that big recovery there. Now, one thing is I think 2018 was when you were seeing those rising interest rates. They seem to have benefited a little bit from that. But this big collapse, even before the collapse in 2007, 2008, they were already crashing the return on equity. So it's not a great sign that you want to see there. I like the stability here, but again, it's hard to predict, like, is this 20% sustainable? I would guess not based upon this history. 4% in 2017 and 2020 are not good numbers, so you don't want that to be your number. When we look at a 10-year median return basis, you see return on equity of 10%, return on assets of 1.3%, so they're basically leveraging up this number to hit that return on equity. Now, I don't like what I'm seeing here in terms of business quality. It seems quite cyclical, and although you only have 1 year of loss in the last 20 years, you don't have enough years that are stably in that double-digit range for return on equity to get me excited. So I'm not super excited at this point. With that said, what is interesting is you have a price to equity of 4.3, which seems extremely low for a company that's able to earn a 10% return on equity. That means that you're likely to get pretty high returns if these numbers are sustainable. So we need to dive on a little deeper to see if that is true. Now, what you do like to see here is you see this gross loans growing at 6%, 7%, net income growing at 6%, earning assets at 8%, deposits 9%. Just constant, consistent, you have consistent like revenue growth over time. You're seeing this net interest income growing pretty sustainably. There are some decreases, but you've grown a decent amount over that time period. Let's see. But the EPS is jumping all around. I mean, you begin the decade at $6.11. You end the decade at $26.94. Now, what's interesting about this is 5 times higher than the year before, 2 to 3 times higher than 2019. So this number is just huge way out there, and it's really hard to tell what's going on that's driving that number. So I have some concerns that, yes, this is a PE of 4.3 on the most recent year, but it's a PE of 25 on the year before that. So you need a PE of basically 12 to 13 on a 2019 number. So what's the right number? This makes it really hard to value the company when you have years that look like this. Minus 53%, plus 420%. That's not stable at all. And it's very, very unpredictable. Unpredictable earnings is a hallmark of a low quality business because predictability is one of the highest hallmarks of a high quality business. So if you're liking this video so far, please hit that like button. Your likes help me to grow the channel, get the audience in front of new people. That really drives the YouTube algorithm. If you really enjoy these videos, hit that subscribe button and ring the bell so you can get notifications as I upload new videos each and every week. Let's dive on into the income statement now. First thing I like to go look is shares outstanding. It looks like they have been decreasing the shares outstanding over time. They're buying back shares, not every year, but pretty sustainably. You've seen these regular buybacks. I like seeing those numbers. Provision for credit losses. Now, the provision for credit losses is clearly jumping around. That jumped up to a huge degree in 2020, and it looks like they gave back some of that in 2021, and that's driving some of these big changes in earnings. So that gives you some idea that maybe the business isn't as volatile as these numbers are saying because you have those provisions being in there as well. One thing I'd really like to know looking at this, see if we have it in key ratios, is the efficiency ratio, but that would require a little bit more work. Doesn't look like they're going to give it to me here. We'll go to the balance sheet. Again, for a bank, PP&E is not a really big deal. You have giant assets. You basically 2 extra assets from 206 million to 432 million or billion. Sorry. Pretty stable security and investments portfolio. They have a big growth in their loan portfolio. This really drives, of course, the ability for the company to operate on those loans, those net loans. You see the loan loss reserve. So that giving back some of that reserve in 2021, again, really driving the change in the business on the bottom line. Long-term debt. So, of course, they have debt here, but really they're driving it most by deposits. So that really captures all the little pieces. Cash flow is not going to really be a huge thing. What we can get from this is you have stock-based compensation, pretty standard throughout the time, 200 to 300 million, but they're generally buying back substantially more in that in stock. It's not an every year thing, but over a period of time, they're definitely buying back much more in stock than they are issuing. So that's a good sign. It's why those shares outstanding have declined. So for me, I think I would pass on Capital One Financial. There's a lot of more interesting financial companies that are more stable. There's a lot more banks that are more stable than this. This volatility is quite poor and makes it really unpredictable, especially the last 3 years. I have no idea how to value this company going forward. Do I use $26 a share? Do I use $5 a share? Do I use $11 a share? I don't know what the best number is. I would guess something in this range of $10, $11 is more sustainable, 2018, 2019. That would be an optimistic view at it, but then put you at a PE of like 12, which could be good, but you'd still like maybe a little cheaper with this return on equity, but it's okay. But for me, I would pass because I think there's better opportunities out there, but there's nothing bad here. Again, profits 19 out of 20 years, that's good. It's probably just an average company. I would consider this an average company, not a high quality company. So for me, I'm going to pass. If you enjoyed this video, please hit that like button. Your likes drive that YouTube algorithm that really helps me grow my audience. If you like what I'm doing, I really appreciate those likes. Don't forget to subscribe and ring the bell so you can get notifications as I upload new investing videos each and every week covering companies that you might like. Until next time, stop paying fees, start building wealth.